Hey everyone, welcome to the final bar. It's August 17th, 2022. David Hunter from Contrarian Macro Advisors is joining us on the show today. We'll hear his take on the overall market environment. It's a bear market now, right? We're down one day. I don't know if I would agree with that statement, but we're certainly seeing some short-term weakness as the S&P is bouncing up against the 200-day moving average. Not just that, you're seeing some good bounces in retail. We saw the big box retailers earlier this week. Today, hitting the 200-day moving average. Ladies and gentlemen, this is the final bar. Hello, everyone, and welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny and warm Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of technical analysis. The technical toolkit is designed to help you really learn the lessons of market history, understand market dynamics, and really embrace the realities of market psychology. Investors tend to overreact. They get excited, they get desperate, they get euphoric, they get despondent. And a big part of the technical toolkit is capturing those extremities, right? Capturing those extreme readings when the market has gone too far, too quickly, one way or the other. Now, a lot of people have been talking, and myself included, talking about the rally from June into July and into August as being a very contrarian move, right? The overall trend has been down. This is a counter trend move, a bear market rally back to the upside. But over time, you're seeing renewed strength. You're seeing these stocks, including the major averages, hit resistance and then plow through them. Dow theory and what I call the new Dow theory, looking at the S&P and the Nasdaq, all giving green lights to this rally. So what's next? Well, here's the situation. The major averages becoming overbought. Major averages approaching key resistance. The 200-day moving average is now in play. There's not a lot of resistance left for the S&P 500 between current levels and 4,600, which would be the highs from February and March. So what can the charts tell us about the likelihood of continued upside there versus backing and filling, retesting the lows? We'll look at the charts, particularly breadth indicators today, and see what answers we can come up with along those lines. I want to share with you the schedule coming up here. I'm excited to talk to David Hunter, who's really a true contrarian here in a few short minutes. Coming up tomorrow on the 18th, we have Jeff Huge from JWH Investments. Really good macro approach, but also excellent at stock picking as well. Next week, two great guests, Craig Johnson from Piper Sandler in Minneapolis, and then Tony Dwyer from Dwyer Strategy and Canaccord Genuity is going to be joining us on the 25th. A couple other special events to let you know about. I'll be doing a free webinar next week through market misbehavior called Seasonal Struggles for Technology. August into September actually doesn't tend to be a pretty good time of the year for technology. The tech sector is actually usually underperformed in those months. And we're going to look at what the evidence tells us right now and how that relates to previous fall, sort of end of summer, beginning of fall sorts of periods. You can go to marketmisbehavior.com/technology to sign up for that event. It's coming up next Tuesday, the 23rd. At 1 p.m. Eastern. Also, our registration is open for ChartCon 2022. We are super excited to present to you a special virtual event, ChartCon 22. Go to StockCharts.com/ChartCon for more information on our keynote speakers, Larry Williams and Linda Raschke, a fantastic group. I think we have 16 or 17 different presenters, many of which we are actually bringing out to our new studio in Redmond to broadcast live from the office here and share expertise, education, and insights about what may come through year end. Go to StockCharts.com/ChartCon to sign up for that upcoming event. Let's continue on with our market recap. Let's talk about what the conditions are like as the S&P is now testing the 200-day. Today pulling back a little bit, but let's see how today's movement fits into the big picture. The S&P finishing the day just below 4275. That's down 0.7% from yesterday's close. The Nasdaq Composite a little bit further, down 1.25% from yesterday. The VIX is actually just back above 20. Now, that's important, I would argue. We'll probably dig into sentiment indicators a little more on tomorrow's show. We don't have time for it today, but we will certainly look at the chart of the VIX. VIX around 20 has been fairly consistent with market tops so far in 2022. We've been right around that level, though. We've pulled back to 20, have been kind of hovering there for a little longer than normal. Would be interesting to see how that plays out, but worth noting where we're at relative to where we've been. The dollar index, not too much of a change from yesterday, up just a token amount. But the rest of this page showing you interest rates for the most part in the green, particularly the longer end of the curve. 10-year yields, long bond yields, all pushing higher a little bit. 10-year yields right around 290, 30-year yield up to around 315. Commodities, mixed, to be honest with you. Gold and silver, sort of the precious metals, down a bit. Gold down about 0.7%, which has not been a good year for gold by any stretch. And I feel like so many opportunities. And again, if I was told before the year started that inflation was going to be a huge focus for investors and for the markets, I would assume that gold would just be ripping higher. Now, what I wouldn't have thought through and what I probably wouldn't have guessed is how much the strong dollar has related to that, right? Stronger dollar means it's really hard for gold to mount any sort of appreciation because it's, of course, denominated in dollars, and that's killing any potential upside there. So the GLD down about 0.2% today. Energy mixed, to be honest with you, and the energy sector is actually the only one as I'm looking at the final results, finishing in the green today. A lot of red on the page of cryptocurrencies, particularly Bitcoin and Ether, which we tend to focus on. Bitcoin now around 23,200, Ether down to 1830. So Bitcoin, again, so many attempts to try to break out, to try to move higher. You can think of that as sort of a risk-on proxy because it's certainly a good amount of speculation coming off quite a bit here in the last 24 hours since yesterday's show. Let's look briefly at a chart of the S&P 500, continue our market recap, touching on some key charts and a couple individual names that I think are worth highlighting here today. So here's the story with the S&P 500. I've talked about this blue shaded area for quite some time, and my comment for a while has been, I'm looking at the 4150 to 4200 range. That is the June peak when we sort of rallied off 3650. Seemed like a pretty logical upside objective to focus on, mainly because the last significant rally we had seen, the most significant rally so far in 2022 was in February into March, and we basically failed in an attempt to break to a new swing high. And that was a great indication that the bear market rally there had fizzled out and that we were going to retest the lows, which we did, and then obviously much, much more. Different this time, right? So you had the briefest pullback from those levels and then just plowed right through it. Now we're testing the next level up, the 200-day moving average. But for me, the fact that we've gotten above 4,200 with such authority tells me that there's obviously a lot of upside momentum. There are a lot of buyers willing to come in, not just what feels like a bear market rally, but certainly something that could be more sustainable. Now, having said that, the reality is in the short term, the S&P 500 is overbought and actually just coming out of the overbought region today. Now, that might be interesting because if you look at the last time the S&P was overbought, that was in November of last year. We had about another week of going higher after it came out of the overbought region. And then we had a pullback to the 50-day moving average there in early December. That set the stage up for a move to new highs. We're obviously in a very different configuration now, but again, overbought. And usually when you become overbought and then pull out, more often than not, you get a brief pullback, a week or so. And that could be what we see. Maybe today is the beginning of that. But again, the charts will tell you what is certainly playing out. I think the 200-day moving average, I'm not surprised to see a pullback from those levels. Getting above that level would certainly be yet another vote in the bullish column of evidence that we've seen building over the last 2 months, really since the bottom in mid-June. Looking elsewhere here in our market recap from a sector perspective, energy really the only one in the green, everything else below zero today. The energy sector, XLE, up 0.8%. Utilities and consumer staples, not too far off of the zero level, but it's the growthy stuff that really dragged the market down today, with communication services down almost 2%. Materials down there as well, and then consumer discretionary, the XLY, down 1.1% today. Again, it's very interesting to look at some of these thematic moves. And one of the things that I talked about with one of my guests recently was the participation in retail. Now, one of the interesting sort of components to 2022, and really this started well before that, if you look through the bulk of 2021, the XRT, which is a retail ETF, really didn't go anywhere, right? You moved higher at the beginning of 2021. That was essentially the high watermark for the retail ETF here, the XRT. We really didn't get much further than that. Briefly got above there in November of last year when a lot of things topped out. The S&P made a higher high in January, but the retail ETF was one of many that actually made a lower high at the beginning of this year. And from there coming down, but look at the relative strength, which was negative that entire time. So one of the things that's been really different, I would argue, in the last 6 to 8 weeks has been the participation of retail. The XRT is actually making new swing highs, getting back above the 50-day, improving momentum, improving relative strength. And I think when you look at that, you have to look at names that are on the list of earnings this week and see what happens. TJX reported before the, I think it was before the open today. If not, pretty sure it was. Nice move higher, right? Up almost 3% today, clearly outperforming the S&P, back above the 200-day moving average. Again, what concerns me, stocks like this becoming overbought. While that might be a good sign overall for a broader recovery, it tells you in the short term we've moved aggressively to the upside and probably need to digest some of those recent gains. That makes me think of the chart of ROST stores. Again, a nice move out of a low at the end of June, but again, hitting the 200-day moving average. This is a stock that has bounced up to its 200-day a number of times in the last year. Every one of those times so far, going back to last August, the market has repelled that advance. That's been the end of the move. It doesn't look a lot like the chart of the S&P 500, very different return profile. But in March, April, yet it bounced to the 200-day, we stalled out. Again, we're seeing a similar rally, overbought just like we were in April, and we're right at the 200-day moving average. I think with all of these names like Ross Stores, with Home Depot, they are approaching their 200-day just like the S&P. The bull case for stocks would certainly involve these names powering above that level of resistance. That's still a very big question mark, I would argue, as this rally phase seems to continue. Let's take a quick commercial break. We'll be back with today's guest, Dave Hunter. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We appreciate you so much joining us every weekday after the close for the Final Bar. A couple quick announcements before we bring on today's guest, David Hunter. First off, we welcome your questions very much. We appreciate you helping us guide you in the right direction as you are attempting to use the StockCharts platform to make better decisions, to inform and to inspire you to improve your decision-making process. Our email is thefinalbar@stockcharts.com. We are on Twitter @FinalBarSCTV, and we're on YouTube. Just put a question below the video you're watching in the comment section of YouTube. We'll gather all those and hope to answer one of yours live on the air in our next mailbag segment on Friday's show of this week. Also, go to StockChartsTV.com. That's our on-demand platform. Guest interviews with David Hunter, Mish Schneider, Tony Dwyer, so many other knowledgeable expert opinions that you can go through and review and learn from. And also a great amount of educational content is available every trading day for free at StockChartsTV.com or on your mobile device. Just search for StockCharts TV on demand. I want to welcome on today's guest, David Hunter. David's the Chief Market Strategist at Contrarian Macro Advisors, coming to us from New England and New Hampshire. David, it's great to see you and welcome back to the show.
Yeah, hi, Dave. It's great to be here.
So walk us through what you are seeing. Obviously, there's been a lot of, there's been quite a change of character, right? With this market making new lows in June and then starting to rotate to the upside. As you are seeing and hearing all that's going on, where are you at right now in your, with your perspective?
Sure. Yeah, I had thought, I saw a setup where we were going to see if turn at 4,200 and maybe get back to 3,800, kind of a retest, but not go all the way back to the lows. Once we got well above 4,200 towards that 4,300 area, I realized that was probably not going to happen, and I switched to saying I think 4,100 looks like it might be the floor. And obviously we ran up to that 200-day moving average you noted almost perfectly, and then reversed. So it's very possible we're starting to move back down a couple hundred points that, like you say, might last a week or a little more. I think an equally possible scenario is that it pushes through that 200-day as soon as tomorrow, but within the next few days. And if we do, I think you're going to see a lot more short covering come in and things, because a lot of those guys have been holding on and saying, we're so sure we're going lower, we're not going to cover. And I think if we push above the 200-day, you're going to see those shorts be forced in. And that could take you up a quick 300 points. in a matter of days or a week or two. And so I think 4,600 or thereabouts, maybe a little above that is where I think we're headed. And then we can have a bigger correction because, as you noted, we're overbought. The VIX is very overbought or oversold, I guess, and due for a reversal here. So you might get as big as an 8 to 10% pullback from 4,600. Take you back to 4,200, something like that. And whatever that correction is, I think, is a final correction before we really melt up to 6,000. So I think, yes, there's probably a pullback coming. The question is it from right here or is it from 4,600? I'd bet more likely 4,600.
Very interesting. It's kind of certainly a bullish take here, and it's amazing how the evidence has certainly rotated more and more in that direction. I totally hear you. Now, one of the challenges, I guess, to that thesis is interest rates, right? How would you relate what you're seeing with the interest rate environment with the Fed versus what you just said with sort of a bullish perspective for stocks?
Yeah, I think I am the bull on the street on bonds. I expected a correction back to 3% and said on the 10-year, said could even get up as high as 315, 320. I now look and it filled a gap at 290 today. I'm not sure we're going much higher. We might get to 3, but I don't think we're going higher than that. I have a view that we'll see before the end of this year 180 to 2% on the 10-year. So I think we're almost done with the correction on bonds, and it's about to go off to the races. I'm pretty bearish on the economy, both from here, but even more so next year. I think you're ultimately going to take the 10-year down into negative territory. So you will see 0% and probably negative rates next year on the 10-year.
Talk about a change of character. That would certainly be it, David. When you're thinking then, when you're looking forward, if we do have limited upside for interest rates, if interest rates do come down, that obviously would provide plenty of room for growth stocks to flourish in that environment. That's been one of the challenges. Is that where you would be focusing your attention as an investor, sort of the growth areas of the market, technology, consumer, or is there a particular area of the market that looks attractive given these assumptions that you're making?
Yeah, I think it's going to be a very broad rally. If we go to 6,000 on the S&P, obviously it's a big move. I think it's going to be broad-based. You're going to have a lot of people buying the growth stocks because rates are coming down. But at the same time, you're going to have a lot of people rotating into the cyclicals because they believe the Fed is going to pivot and that next year is going to be a better year. That's not my outlook for next year, but I think that's what the market's going to decide for at least a few months. So you can see copper stocks move up aggressively at the same time that you see, Amazon moving up or, Salesforce moving up. So I think you're going to have a and I think it's going to be large cap as well as small cap. So I think it's going to be very broad. We haven't had a broad rally for a long time. I think that basically, I think June marked the bottom of a big correction, sort of not to the degree that we had in March of 2020, but if you look on a long chart, it's another a major turning point in the market in a continuing bull market. So you have another leg up. I think it's the final leg up in a 40-year bull market. But when we get there, and I think it's going to be a steeper leg than the March 2020 to December 21 market. So, could happen in 6 months, could happen in 4 months, could happen in 8 or 9 months. But I think you're looking at 6,000 within the next, within the next 6 months.
That is a lot of upside to think about, David. Listen, you never disappoint with some really thoughtful perspective and nudging our thinking on what is possible with these markets. Really appreciate you coming on the show. It's great to see you again. Stay safe there in New Hampshire, and we'll talk to you again soon.
Thanks, Dave. You take care.
That's David Hunter. David's the chief market strategist at Contrarian Macro Advisors, joining us from New Hampshire. Boy, some interesting perspective there. S&P 6,000. Talk about an upside target. And again, what I love about David's thoughts is it immediately makes me think: what would a portfolio I might structure now with sort of the bear market rally hat on, right? If we are seeing that much more upside, another 30, 40, 50% rally even from current levels, what would that portfolio do? At what point would you need to change things? How would you manage risk in that environment? How do you protect against alternative perspective? Really an interesting thought, and also on interest rates, which is a bit of a certainly a contrarian perspective, seeing rates go down that aggressively. A great take there from David Hunter, and very much appreciated. Let's continue on today's show with our next segment, Banking on Breadth. What we like to do with some regularity is focus on market breadth indicators. I was on Fox Business earlier this week, and we were talking about market breadth. And what I was sharing with all of them is that breadth is all about participation, right? Breadth tells you if the major averages are doing one thing, what about the stocks that comprise those indexes? Are you getting broad participation, or is it a relatively narrow move in the markets? That's what breadth indicators are designed to help you. What about the stocks that make up those groups of stocks reflected in the indexes? Let's look at the charts together here. We'll start with a chart that I refer to very regularly, so I don't want to beat it too much in terms of reviewing it, because I think we've covered it pretty well on the show recently. But I just want to start off with the fact that the cumulative advanced decline lines for all major cap tiers that I follow, the broad New York Stock Exchange, the S&P large cap, mid cap, and small cap, all making a new swing high in the last couple of weeks. Small caps, if I remember right, were first. That was back here in late July, but one by one, all four of these have broken above their June highs. So the S&P, of course, made it through there about a week ago. Now, all of these in terms of price and in terms of breadth, all confirming this upswing. So again, if you are thinking of a retest of the lows of a pullback, what this chart tells me is that the broader rotation is kind of happening, that this move that we've seen is really an impulse move. It's not a corrective move. And that's a very different feel to the tape. But that's what the breadth condition is becoming so positive probably indicates you more than anything. Next chart I'll show you is looking at stocks above their key moving averages. Now, this is an important one for a couple of reasons. It's currently around 92% of the S&P members above their 50-day moving average. That's pretty high. And now theoretically it could get up to 1,000, but that's pretty unusual. That would be in an incredibly raging bull market phase that literally everything would be above the 50-day. It's happened, right, on a limited basis, but overall above 70, 80, 90, you're getting into a relatively small number of observations where this indicator has gone that high. The last time you had over 90% of the S&P above their 50-day moving average was back here in April of 2021. Now, before you get too excited and think, well, that's great, because after there we did another, 6 to 8 months of an uptrend. You have to remember the conditions leading into that signal are very, very different. Here, we came off of being at 5%, going up to 90+% within about 8 weeks, which is quite a rotation. Talk about a change of character in this market. So while that, again, I think that's concerning potentially in the short term, because it tells you so many stocks have had such a run, this indicator rarely gets that high unless it's more of a bull market phase. That's more of a bull market phase kind of reading. Same thing I would tell you about stocks being overbought or the S&P being overbought. While in the short term, that tells you things might be overheated. Things don't usually become overbought when they're in a bearish trend, because there's never enough buying power to get you up to those levels. So it's short-term concerning, long-term actually pretty encouraging in terms of further upside potential. Another reason why this chart could be really interesting to watch is this the panel just above where we were looking, which is the percent of stocks above their 200-day moving average, currently teasing that 50% level. And yesterday at the close, it was just above 50% for the first time since April of this year. In general, I have this little pink horizontal line at the 50% level, because I've found when these indicators are above 50%, that is more of a healthy market environment where over half of the stocks are in an uptrend phase according to that particular definition. If it's below 50%, it's fairly negative. Now, we first dipped below the 50% level here in January, sort of teased around that kind of neutral range for a couple months, and then went firmly below it. We are right now testing again that neutral range, right around 50%. Can we get above that 50% line and continue? And that's why I think that could be an important chart to watch going forward here. Really quickly on bullish percent indexes, these are a methodology looking at point and figure charts. Let's review all 500 point and figure charts of the S&P 500 members. Are they in a bullish signal or a bearish signal? Right now, it's at about 80%, which means 4 out of every 5 S&P 500 stocks are still in a bullish phase, or now in a bullish phase, according to their point and figure chart. Back here in mid-June, by the way, it was almost down to 10%. It was around 12 or 13%. above their or in a bullish signal. So most of the S&P, an overwhelming number of the S&P members, have now generated a point and figure buy signal along this rally phase. And again, that's a significantly strong indication. Last time we were this high, again, April 2021. And again, that was setting the stage for much further upside. And you had pullbacks along the way there, but overall, the trend was very, very strong. This next chart, though, is a really interesting one. This is where we might have to stop it. This is the Nasdaq 100 Bullish Percent Index. So again, only 100 stocks here, so a smaller group. And again, very overrepresented in technology, communication services, consumer discretionary, kind of the FANG and FANG-like sectors. But if you look, there have been a number of times going back where this bullish percent index has gone above 70. Going back to last fall, you can see when we've gone above 70 and then gotten right below 70. You saw that in early September of last year. You saw that in mid-late November of last year. And then I have some of these highlighted in pink. These are all the observations in 2022, here in mid-February, here in early April, and here in early June. What happened every time we became overbought and then came out of that or went above 70%, came back below those that level? That was the next leg down. Now that we've had a big run, I am keenly watching this chart to see if and when we break below 70%. That might be the indication that we're starting to rotate lower a little bit. And that, again, you're starting to see some sell signals materialize on the NASDAQ 100 names. Okay, I can't help it. I'm going to show just one more very, very quickly. Volume. Look at the volume picture in 2021. The S&P 500 has had down legs and up legs this entire time. Now, obviously, most recently, it's been much more of an up leg since mid-June. But if you look back, look at the evidence. Besides July, every other time we've been going up, it's been on lighter volume. When we've been coming down, it's on stronger volume. And I'm broadly generalizing, but look at the chart and look at the trend in the volume and the trend in stocks. And you can see in general, down phases have been on heavier volume, up phases have been on up phases have been on down volume, down phases have been on stronger volume. So the momentum has been down. That changed here in July when the market, for the first time in 2022, rallied on heavier volume. But look at how that's changed in August. That uptrend in volume in July has now reversed, and you're seeing less volume as we get further and further. Could that be an indication of nearing the exhaustion point of this uptrend? I'm not sure yet, but I think this is an important chart that so far has matched pretty well the momentum behind some of these movements in price. We need to wrap the show and go to the 3 and 3. Let's talk about 3 charts in 3 minutes that tell the story of this market environment. And here's chart number 1, but we're going way off script. We didn't talk a lot about cryptocurrencies today. I was hoping to, but we had to make room for some other charts to highlight. But I was asked by one of my market misbehavior premium members about this particular ratio, and I shared with them a bunch of details. I just want to give you a quick takeaway to share with you some ideas here. If you look at the ratio of Ethereum to Bitcoin, so it's literally a ratio of the one versus the other, and I'm looking at that performance. I have the chart of Ethereum at the top, so you can see this over the last 2 years. The second panel down in blue is the S&P 500 on a closing basis. At the bottom, the ratio of Ether to Bitcoin. Look at how closely the S&P 500 matches this ratio. It's almost like Ether is the risk on and Bitcoin's the risk off, which I haven't thought about the implications of this necessarily, but I'm struck by how closely these match. For the record, the ratio has been going higher since mid-June. Again, this is another one I would watch for confirmation if and when the S&P might stall off. That's an interesting one. If you have thoughts as to why that plays so well, let me know. I would be very interested to hear. Chart number 2 is ROST stores. We talked about the strength in retail, the XRT really materializing. One of my recent guests was talking about the importance of participation in retail and how much that has really started to evolve over the last 6 weeks or so. Since mid-July, ROST stores has been moving higher, but I'm concerned that it is overbought as it reaches the 200-day moving average. The traditional technical toolkit would tell me to expect a pullback, just like we saw in April, just like we saw in last November. Let's see what the chart tells us. But overall, stocks like this have had a good run. And while that's been encouraging, supporting the uptrend, it also could indicate that we're starting to near the end of that move. Finally, a look at volume. Volume is not a huge component to my process, but I learned a long time ago to be open to everything. And that's why I talk to people who are Elliottians talking about wave counts, who are Gann strategists talking about price and time, squaring using the Gann methodology. And here we can look at the volume. The volume had been positive in July, which was very supportive for once of strong move higher on heavier volume. That has changed now. August, we're seeing lighter volume as the S&P has gone to the upside. Folks, that's a wrap for the show. I want to thank David Hunter joining us from Contrarian Macro Advisors, sharing us some really thoughtful takes on the overall market environment. All of our previous interviews are at stockchartstv.com. And for Stock Charts in Redmond, Washington, I'm Dave Keller. Have a great night. We'll see you tomorrow.
Hey, Grayson Rose here with Stock Charts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.